A round of introduction. Hi, my name is Audrey. I'll be your chair today. I use she, her pronouns, but I'll prefer if you refer to us panelists as a whole. And judging with me are
Hi, I'm Adya Banaschi and have been around.
Hi, Lynn, she, they pronouns. Best of luck.
okay. I will send time signal in the chat before you begin. Oh, sorry. Let me start the ballot. Sorry, give me 1 second. Can I get speaker orders in the chat for everyone? And I will send time signal for 1 minute, 6 minute, and 7 minute into the chat. Before you begin, just indicate if you have any preferred gender pronouns and if you and how you want to accept your POIs. Okay, without further ado, let us welcome the Prime Minister. Here.
Thank you, Chair. I just want to ask if I'm fully audible to everyone.
Yep, you're fully audible to me at least. I'm not sure.
That's what
no one
matters.
flagged. It should be fine. Yeah.
Okay. 1 sec. Okay, I'm ready. 3, 2, 1. Firstly, let's do some framing and talk about, I know this is not a policy motion, but let's talk about who provides that insurance. I think it's very clear, very important to understand so that the model just doesn't collapse after my speech, right? So it's like things like multilateral agencies, like companies that affiliated with IMF, with World Bank. It's government agencies, it's banks, it's private insurance, it's brokers. So very important thing at the very beginning is those people who provide that insurance for the foreign direct investment very often also provide loans. It's like the same industry, even though it might not be exactly the same company, it's the same industry. This is going to be very important for my incentive analysis that's going to come in a second. So what does this process look like? Let's say that a German car manufacturer, Volkswagen, for instance, wants to build a factory in a country like, I don't know, India or like Thailand, in developing nation in Southeast Asia, for instance, like just for framing. Then before it's accepted that they can invest there, they need to go to one of those companies that are the providers of that insurance and buy insurance. And if they cannot get their assets back, or their assets get lost because of natural disaster or a war or anything as per the info slide, they get their money back from the insurance. Important framing here is that the turmoil or natural disasters, they do not happen constantly. If they happened constantly, people wouldn't have an incentive to like invest using FDI in those places in the first place. However, when they happen, they are quite severe. So they are quite rare, but on this, like they're quite rare, but on the scale of when they happen, this becomes the problem. Incentive analysis. Why those agencies who provide the insurance have an incentive for this to happen and for this to be good in the first place? The bigger the investment, the higher the payout. As in, if you invest $100,000, you're gonna get X money. But if you invest $1 million, you're probably gonna have 10X money, or at least more money. I.e., the bigger the investment, the bigger the price of the insurance, which means the companies get the benefit. Secondly, investors. The problem with investing in third world countries is that you have a trade-off. The trade-off is you're getting the benefits of investing in a developing nation, cheap labor costs, or just like easy ability because like the labor work, the labor laws and like the protection of labor is much lower, which means you can have more profits and like produce faster and with lower protections to the employees, which for those companies is insanely good. And thirdly, what's important is the trade-off is that very often those companies are hesitant to invest in those nations because of the paradigm I explained. The crises are not constant, but when they happen, they are quite severe. So it's like kind of high risk, high reward. You risk a lot by investing in those countries, but the reward, if you succeed, is very high because your profits are very high. And thirdly, incentives of governments of developing nations. It's very simple. They get more FDI. We're going to prove to you from opening government that the main and basically the only reason that you need this is there is more FDI. More FDI is beneficial for the nations investing, but for the nations that receive the investment and therefore can be improved. Okay. Less risk equals more FDI. So as I explained to you, there are already sort of incentives to invest in those nations. Cheaper labor costs, higher potential profits. You don't have to worry about training like internally because everything is happening in a factory elsewhere. However, the turmoils are the trade-off. That's happening is debate. If you invest in a country that's very cheap for you, which means very profitable, but there is political trauma or like the differences between ethnic minorities, which may cause trauma. If the nation or the region is very often plagued by natural disasters, this is the trade-off you have to accept. So from a perspective of an investor, this is like a safety net mechanism, i.e., I invest in this nation, I take the risk, but this is the insurance that's gonna assure that if shit hits the fan, I'm gonna get some of my money back. And now to preemptively away up and like whatever they're gonna try to say. There is a very high incentive for those insurance companies to still exist on a very competitive basis and to still keep the insurance relatively cheap. Why? Because if the insurance to invest in those nations becomes so expensive that the idea of investing and building a factory there becomes unprofitable, those rich nations, those Western nations, are either going to be producing stuff locally or are going to go to other Western nations because it's gonna become cheaper not to use FDI and not to outsource to a developing nation. In that case, those insurance companies, but also the IMF and the World Bank are losing out at the amount of potential trade of the capital flow and therefore their own benefits for like currency exchanges and shit, because now it becomes cheaper to produce locally. Therefore, it's an incentive of IMF, World Bank, and all of the insurance providers and banks to keep those insurance industry competitive and at the same time extremely cheap so that it's still profitable so they can still get their profits. Before I continue, CEO.
Why is it the case that these insurance companies are, governments and not-for-profits when it's more likely that they're for-profit companies that are providing this insurance on the free market?
Yeah. So it doesn't matter if it's governments or not. It doesn't matter. Even if it's private insurance, they still have an incentive to exist in a competitive market because there isn't going to be just one agency that operates this. I presume that like most commercial banks are going to have enough capital to provide this insurance. And commercial banks also loan money so that the FDI can be unlocked in the first place, which means they also have an incentive for that insurance to be cheap. Because if that insurance is too expensive, people don't engage in that bank. Therefore, they don't invest the money. Therefore, the bank doesn't have it because therefore the bank cannot make its profits. Okay, why is FDI good, right? There is like what, 6-7 mechanisms as to why is FDI good for those specific countries in the first place. They have economic growth because there is an investment in foreign, much stronger currency that wants to build factories. If you want to, if a foreign country builds a factories in your country, which means you have more employment, which means people who wouldn't have employment in the first place because you cannot provide it as a very poor and turmoil government, now you have that employment. Which means there is more tech and expertise because engineers from a much better, well-off country now give you the tech and expertise to build a fucking factory that's gonna build Volkswagen, Volkswagen, Toyotas, or everything. Which means they're gonna be better infrastructure, housing for those workers, trains to get those workers from the housing to the factory, better motorways, better education system so those workers are educated enough to build those cars in the first place. More taxation because you still get profits from that foreign company to build on your land, so you get profits. Diversification of economy. If those countries are purely agricultural, you get now something else that if there is natural disaster and agriculture fails, you can get profits from elsewhere. And likely access to cheaper goods. If you're producing cars, you're likely to wanna be able to buy some cars from the company in the first place. So yeah, investors now have a safety net and they want to invest. So therefore, they get the investment, and also poor countries, developing nations get the benefits of receiving investments. For those reasons, OG.
Thank you, speaker, for that fine speech. Let us welcome the leader of opposition here.
If you have a POI, I'll try to take it around 5.5 minutes. I'll just stop and then you can unmute. If you have a POI before then, I'd prefer you unmute and say it, although I'm not sure if I'll take it. With that being said, is everyone ready?
Yep, whenever you are.
Perfect. 2 premises OG is missing. First, why must this form of insurance be mandated rather than possible? And second, how do we actually calculate risk in these scenarios? On the first burden, if OG doesn't meaningfully demonstrate why this form of insurance must be mandated rather than just available, they cannot win the round. Obviously, if I'm investing in the Maldives, I will purchase insurance to account for constant water level increase slowly covering the island because these insurance options currently exist. The difference then is why must they be mandated for every investment of this nature? And we'll cover why that is bad below. Second, how do we actually calculate risk? Because presumably, like all insurance, there will be premiums charged for this form of insurance. And the amount those premiums cost will be predicated on the perceived risk of that country. So the question then is, how do we calculate this risk and why then is it negative, as I'll explain. Before that, 2 pieces of framing followed by 2 arguments. First, investment happens on either side of the house. 1, the insurance just exists either way, as I covered above. It is currently possible, just not mandated. Notably, the market won't grow on side government. The ability to even pretend you know the risk of whole economies and you have predictive capability on geopolitical events and natural disasters, which as OG tells us themselves are unpredictable, mandates immense size and scale of your information gathering capacity and ability to calculate premiums and issue loans. Rather, this means that the market has already been captured by both providers and information gatherers, which are likely combined in multilateral insurance corporations. This means that the market is likely a monopoly right now per the above. And when this mandate comes into play, because all investment is now mandated to use a market that is already captured by the monopoly, the people turn to the best available option, which is a few or one large corporation that then continue growth and capturing the market. So they don't get lower premiums, they don't get diversification. Second, risk management is just a tenet of finance. It's already calculated and already used in these investments. Third, investment has been an increasing global norm without gov in SQO. So there's no reason that would uniquely change when you mandate this insurance. So we think that investment continues rising. Second, then, is that it's bad when your investment doesn't have to care. And what this means, and it will be important for our first argument, is that on Gov, when you know you're paying the premium either way, you don't care nearly as much about where you invest because you don't have to make the decision about whether or not to purchase this insurance. That is very bad because of our first argument, which is that caring about and being forced to research where you consider investing creates positive externalities. Having to care about the direction and nature of your investment means you spend more time researching and seeking to understand the place where you're investing to determine the risk. This looks like gathering increased information regarding countries previously dismissed as risky and unstable to determine if you should pay the large premium or if you should even invest in the first place. Second, the largest incentive to prevent geopolitical risk is from having investment staked on it. The knowledge that investment is itself permanently covered results in less risk analysis, less safe investment, and less care. This care is insidious on 2 levels. First is the investor. When people who are representative of governments or particular cultures choose to make this investment without having to care because they have to buy a premium anyway, they no longer have a stake in helping the place where they're investing not suffer political catastrophe or geopolitical catastrophe. Second, and even more insidiously, is that the recipient of the investment no longer has to care because they know that there is not money being lost if they suffer political instability. Rather, the money just returns and they're not going to suffer any geopolitical drawbacks. Our second argument is that there's worse investment. Insurance isn't free and people don't invest in stricken areas because of this. Insurance premiums then are scalar with perceived political instability. Sure, government can say, haha, risky countries don't get investment anyway, and this will incentivize them to be less risky. I'll beat this twofold. First, the perception of risk is itself problematic and neocolonialist. People do things like pumping a country's history into a calculator and attempting to determine a metric for the likelihood of political instability. Or there's bad epistemology surrounding governmental form, where people from the West assume particular forms of government or cultural norms are bad and uniquely riskier. And so the risk for that country is set as higher by this multilateral corporation. This means that premiums are more likely to be high across the board when you mandate this form. Second, countries already don't like having during civil wars, and they know they already get more investment by reducing risk indexes. So Gov doesn't create a new incentive to lower these problems. The world is already so globalized and securitized that countries are already being pressured to act better by global economic ties because they lose so much both geopolitical capital and economic strength by suffering these catastrophes to the point where there is no need to add a further incentive. The result then is that Gov has far less investment. First, the high cost of premiums means less money goes in. Second, and more insidiously, the premiums deter possible investment, so no money makes it through. Third, as OG tells you, these investments are high risk, high reward. When you mandate coverage of high risk, you necessitate huge premiums because it's high risk. As a result, the high reward goes down because there's huge upfront costs and barriers, which turns their mechanism on its head and demonstrates less investment. I'll take a POI.
Okay, closing's going to go for it.
Yep.
Doesn't providing liquidity to a market increase the incentive of financial institutions to do more precise research, shedding their biases, because now they have financial incentives to be right about risk?
Providing liquidity might do this, but mandating it doesn't. The reason is when it's mandated, they know that they don't have to choose between taking this insurance option or not. And when that choice is taken away, the incentive to care is taken away, and the incentive to research further is taken away, which is the mechanism I outlined, which means it's a false solvency that just results in less care. Going into the weighing, I'll take OG at their best, but I still think we care more about stability than investment because local populations see less investment benefit. Neocolonialism results in large foreign corporations being the ones to, one, have the upfront capital to entrench themselves in these economies, and second, have the perceptual benefit to get most investment coming into that economy. And any attempt to get around these corporations, i.e. nationalizing or banning them, gets you dismissed as authoritarian or communist or risky, and it sinks your investment possibility and it raises your premiums, which means the weighing is clear. We care more about local populations being able to exist free from intense geopolitical conflict by powerful actors whose pocketbooks are no longer at stake than we care about those pocketbooks in the first place. At this point, even if OG proves their case, they're still behind. Proud to oppose.
Thank you, Speaker, for that fine speech. Let us welcome the Deputy Prime Minister here.
Okay, firstly, can I just check that I'm audible?
Yep, you're audible and visible.
Great. Just give me 2 seconds to set up, and I'll start.
And no worries.
Okay. I'll be ready to start my speech in 3, 2, 1. Okay, firstly, a couple of extraneous responses to Owa before we build up our case again. I think they make this claim of like neo-colonialism, but fail to actually provide another alternative or an alternative mechanism for a lot of these very developing countries to develop, right? In status quo, the problem is that there are countries that are significantly underdeveloped to the point where like they don't even have basic infrastructure such as like well-running ports, well-running airports, well-running factories that actually employ local workers, right? The problem is that the comparative here is that without any FDI, a lot of these countries struggle to get up on their feet in the first place anyway. Why? I think firstly, because these countries suffer not necessarily constant political turmoil, but like as Mickey's already framed to you, the political turmoil that they face is just much more severe, meaning that like FDI just doesn't even come into those countries in the first place a lot of the time because they're so risk averse of all of these things. I think it's also just secondly significantly harder for local businesses to even build up their own infrastructure, meaning at this point, even if it is to some extent pushing neo-colonialist variables, the life quality changes in those countries is so much more significantly increased regardless of the narrative that is pushed on these. I think also significantly, when you build things that are going to have long-term impacts on the local economy, such as building a port, which is previously missing in the first place, it doesn't really matter whether the beginning of that port has neo-colonialist narratives, right? Insofar as like the locals are likely going to be able to take over this and like use this for their own significant benefit within the future, right? So I just don't think they prove why principally this actually matters within the first place, right? But also other responses to OO, they claim that we don't prove why mandation of this is like necessary or possible. Look, I think first of all, it's mandatory because it protects your own company within the first place, right? When you're an investor, say you have like a car company in like Bangladesh or India or any other country, your workers are also going to be harmed if that company faces significant risks within that country, i.e. if there's some kind of political crisis or your business gets gets ruined or physically like destroyed within that country, this also has a bad backlash on like the company in which it originates from, right? Okay. So why this is necessarily going to happen? In status quo, some investors have incentive in order to cut corners, i.e. you might go up and set a factory in a country because you make on like cost benefit basis that like it's not necessary to have this insurance, meaning that when all of this harm does actually happen, it comes back this much harder because you're not going to able to like restabilize this company within that country. Like you're probably not going to bother rebuilding it back up and therefore re-providing those jobs to the workers who have like lost their jobs, right? Meaning that like this is just quite like a significant harm. On our side, if you make it mandatory, then they have to have this bare minimum insurance that like protects their company and protects those investments, right? This is inherently a good thing, and this is why it has to be mandatory. But also, secondly, on like cost benefit payoff, like why it needs to be mandated. Some developing countries, as we've already stated, barely get any FDI within the first place. At least with a mandated system where you already have to pay some kind of premium, you're probably going to consider other countries within your sphere because you have to pay this premium anyway. The jump from like having to pay some kind of premium to having to pay a slightly higher premium is not going to be as badly for you to be considered as it is on the flip side if you just don't have to pay a premium anyway. You're probably just going to go into already established countries where you already have businesses, right? This means you're probably more likely to diversify your portfolio in the countries in which you're looking at. And this also means that the research is likely to just be better in the first place, right? Because like not only are you as a company going to research countries that have no basic infrastructure, and you're going to want to be the first one to get in there in order to make the maximum profit, right? Because there's such a big gap in the market. But also secondarily, it means that insurers are also going to just do the research better, right? Why is this the case? Look, I think because previously there wasn't such a huge demand to like invest in these countries in the first place. Now insurers want to compete with other insurers in order to make sure that people actually buy their insurance. This then means that they're going to have like huge incentive to actually do their research on what the likelihood of the political turmoil is going to be. So I think like the research into these countries is just likely to be better in the first place. Okay. Cool. Also on that other claim of that like you just don't really care about this because like the insurance is so expensive. Look, I think like even if these countries are going to be more risky, this then just means that surely they're lacking more basic infrastructure, right? The more risky and more political turmoil a country has means that it probably doesn't have all of those very basic things. This means it's probably going to be a better investment for you. Just in status quo, you do not have as much of an incentive to go into those countries and build those basic infrastructures in the first place, right? At least this gives you some level of incentive to actually diversify your portfolio within the first place. I think this is likely to pay off in like several different ways, right? Like I think first of all, when you build those basic infrastructures, the country is just going to be more economically stable, right? Economically stable countries just also collapse less in the future. This then means that on weighing this is like global impact, because when those countries collapse less because they're economically stable, this is good for like all the neighboring countries because they don't have to provide any financial support to those countries, but also better for like the IMF or just like the World Bank for not having to provide any kind of financial aid because more countries are more stable. And the more countries are more stable, the more they're likely to democratize, right? Because people just have like a better standard of living, better standard of life. They don't have to rely as much on like dictatorial governments. I'll take a POI from CO if they have one. Nope. Over? Nope. Okay, that's absolutely fine. Cool. Just to
sorry,
impact
I
this
have
further.
one.
Yeah, go ahead.
Cool. How would you calculate this risk? A country democratizes, that's good, but then they vote in a dictator. That seems bad. What does your model say to do in terms of premiums?
Look, I think at the end of the day, even if they vote in a dictator, I think it's probably still quite likely that all those basic infrastructures are still going to survive, and that all of those basic businesses are going to have at least provided a better standard of living for those living within that country. This is the bare minimum impact that I think you have to concede to us. The standard of living is going to go up when there is some level of infrastructure within those countries compared to basically guaranteeing that there'll be no level of infrastructure within those countries. I think the problem is on your side is that the gap currently is so huge between developing countries that there is no other way of closing it other than to provide incentives for investors to actually invest in those places within the first place. This is why it's so important that you mandate this as opposed to just encourage it within the first place. I think also Mickey just provides you really important characterization on how insurance companies want people to buy their insurance, right? And I think this is like pretty important within this debate, right? investors have their own capital at risk, which is why they don't necessarily want to go into these countries in the first place. Insurance companies have more capacity and are more likely to like pay out when these political turmoils happen, because it's very likely that they're gaining money from investors that are investing multiple countries at the same time, meaning all of these countries are not going to collapse at once. If you have a crisis in Bangladesh, but your investors are doing fine in Zimbabwe, then this is not going to affect you as an investor, as an insurer, sorry. So you're going to have more capacity to provide this and actually solve those crises in the first place.
Thank you, Speaker, for that fine speech. Let us welcome the Deputy Leader of Opposition. Here.
Yeah, we'll be fine.
You can just put it all in this area. You're both visible and audible, by the way.
Okay.
So I'm ready.
Yep, whenever you are.
I think the answer to my POI is pretty telling that opening government, and I imagine GovBench, doesn't really know how to calculate this risk. And quite frankly, the whole case we provided is that banks won't really know what to do either for a variety of reasons. I'm going to talk about three things. First, why investment decreases on their side of the house and gets worse because of asymmetries of information. Second, why country stability gets worse on their side of the house. And then third, weighing even against their best case. But the first thing I want to handle is the burden on why it needs to be mandatory. Because the thesis of the OG case is, well, once you've paid the premium, you might as well invest. But it's not like everyone's paying the premium regardless of whether they invest or not. The premium is added on once you decide to invest or not. So the claim we're making is on either side of the house, the sticker price for what it costs to put an oil refinery in a like developing country is the same, but on their side of the house, they have the added premium there, disincentivizing people to go. If it made sense to invest, then they would go anyway. The OG response here is, well, places don't go in, so they need to be mandated to go. If it's so risky, they won't go in, and you add the added cost of insurance, then they won't go anyway. If buying insurance was enough for it to be worth it, they would buy it anyway, because guys, this isn't a debate about whether political risk insurance is good or bad. It exists in the world. Massive corporations like Lloyd's and AIG on both sides of the house already offer it. So the question is, in a world where it's already offered, should we mandate it? And our claim is, for places where it is good, it is in the self-interest of countries to want to do it already. This all came out of Ryan and was unresponded to. No country is like, yeah, or no company is like, yeah, I'm going to spend hundreds of millions of dollars investing in an oil rig, and I'm not going to get insurance because I'm fine losing hundreds of millions of dollars here. They might be a little over-optimistic. I'm fine conceding that corporations are a little too over-optimistic, but I don't think they're just so brazenly just not caring about their own bottom line they wouldn't get baseline political risk insurance. That doesn't make any sense here. They have incentives, one, because there is a high amount of interest you can charge when it is a risky place because there are few people who want it, and two, there's a first mover advantage. So I think there's already incentive to go into places that are risky, and if you want insurance, get it. The problem is places now, like if you read the motion, every place that is a developing country now gets this insurance put on them. And our claim is it is hard to ascertain the risk of developing countries because of a lot of reasons Ryan gave you that I'll reiterate later. I want to respond to the POI from CG and what I think they're going to go for. They're going to explain that the reason you need to make it mandatory is so you can get more money to do good research. There's a couple of problems with the economies of scale argument here. First, it is already massive companies that have a lot of capital that are doing as much research as they can. It is so marginal the extent to which Lloyd's is like, now we got a few more people paying premiums, we're going to devote all this money to a research center. Two, to the extent that they are getting more money, it is likely they're just going to give that money back to shareholders. Three, it's unclear in this response to the DPM the extent to which competition is likely to happen. Like, guys, there aren't that many people willing to enter this space because it is, as Ryan points out, really hard to even pretend you know what the fuck you're talking about when you're saying like, oh, we do insurance for the risk in Djibouti or things like that. So it isn't like there will be 15 places all saying we'll do a lower insurance premium. It's like there will be one or two. It's more likely that they'll say, oh, we're like the Africa group or things like that. So they won't compete across all different spectrums of things like this. I don't think it is likely that they do research. But four, like, they don't really need to because the cost benefit there isn't good. Like, as OG points out, political risk, things like expropriation, things like civil wars are pretty uncommon, meaning it's hard for you to have a track record and say, see guys, there were 25 civil wars and we did a great job giving you insurance there. It's hard to do that kind of accountability that is necessary to do the things to access the PR mechanism they want. These are all reasons to suggest why it is that making it mandatory doesn't give you extra benefits. It's better to just let companies pick and choose whether they want to do it or not. Three things then. First, on investment. We told you two things here. First, we told you that they put premiums literally whenever you want to invest in a developing country. country. That is bad because those premiums are not free. These are already really expensive. You don't want to spend even more money having to develop the infrastructure in a developing country. So at the point where you want to diversify or get risk, you go into other things like domestic small cap, or you do things like invest in like Bitcoin or crypto or art. This is what is much more likely to counterfactual on their side of the house when they don't develop in these countries, because on our side of the house, they're willing to invest, but not willing to invest and also pay insurance premiums. On their side of the house, it's just too expensive to go in, especially when they don't think that the insurance is worth it. But secondarily, I also don't think it is the case that it is calculable. Like, look to the POI I asked you. What happens if there's an election, but then there's a dictator? I don't really know what you do there, because they prove that they can vote for someone, but that person's a strongman who might expropriate your oil. Moreover, there were a variety of structural reasons Ryan gave you. He told you about racism and how the history of these places is inextricable from the politics of the status quo. There's a lack of knowledge, oftentimes a language barrier, but there's just a lack of financial statements in history, meaning that even if they're like, oh, this will make it easier for the good places to get insurance, our claim is that it's so fucking hard to determine what the good places are, and the history of racism and lack of financial engineering and tools we have now suggests that the premiums will just be pretty high across the board, maybe marginally better for Vietnam than they are in Sudan, for places where it is literally that obvious, but I don't think that is most of the instances here. So they just get less investment because it is too expensive and the premiums are too high. But secondarily, country stability goes down, the investments are worse. The claim we would make here is, on our side of the house, you have to give a shit if a strong man gets elected, because a strong man can just take your oil rig and then you get nothing for it. So you care more about lobbying or doing things to make it such that the people who get elected or the institutions in place can't just take your oil rig away from you. On their side of the house, you are more willing to work with strongmen because you get the benefits of them violating civil liberties and making things cheaper. But in the worst case scenario where they take your oil rig, you've covered the downside. You can't do that on our side of the house. There's less moral hazard. Before I move on, I'll take one from closing.
No, we're good.
Opening.
Sure. The difference here is that insurers know that it is incredibly unlikely that a civil war will break out, meaning that they don't think they'll ever pay out. But if they do, they won't cripple. Investors know it's unlikely, but they'll be completely crippled if it ever does happen, meaning you need this to encourage them to invest.
One, as you point out, there are tail risks. Even if it is unlikely, once it happens, you have to pay out massive sums of money. So you charge high premiums regardless to counteract that, especially when there isn't any competition here. Your claim suggests that it is easy to determine the risk that these things happen and price accordingly. Our claim is it is so fucking impossible to determine the likelihood that they choose to do hyperinflation, that they choose to take your oil rig, that some junta just comes up and takes over, and that you account for that risk by making the premiums exorbitantly high on your side of the house. Finally, on weighing, there are two things here. First, why stability matters more than investment. Take them at their best. Maybe they get a little bit more investment because, like, the CG claim is true, money goes to the insurance companies, the market functions better. Our claim is the moral hazard argument matters more, because even if they get a little more money in the short term now to build one more oil rig, when you don't care about civil liberties being degraded, that means that the instability that happens makes it such that future investment doesn't happen. When the worst case scenario happens, these things are also likely to happen anyway, because there's a lot of people who want to invest in these things. For all of these reasons, proud to oppose.
Thank you, Speaker, for that fine speech. Let us welcome the member of government. Here.
Awesome. Can everyone hear me okay?
You're loud and clear.
Great. I'll take a POI around 5:30, so just unmute and ask me then. Yeah, is anyone not ready?
Nope, whenever you are.
Cool. At best, OG and OO go back and forth on whether or not this insurance is good. CG is going to do a daring thing and actually address the heart of the debate, which is the question of whether mandating this insurance is good. I'm going to do one piece of framing about why the market for this insurance does not exist for the status quo and why we create that market. Then I'm going to do two arguments and weigh them somewhat against opening. I probably won't do that much rebuttal. I think Audie enjoys doing it himself. First, on the framing question, why is the market basically non-existent in the status quo? First, there's a massive collection action issue when it comes to offering this insurance. Note that per the framing from OO, the large majority of investors choose not to take insurance when it is optional because they forego the increased premium for the sake of just accumulating a little bit of risk on the side. The implication of this is there are very few insurance providers, and the mechanism for providing insurance is very uncertain. This creates a collective action problem where no individual corporation is incentivized to produce a very good insurance contract or tool because the individual cost of producing it massively outweighs being the first mover into a market that doesn't exist. Two, there's just less accurate information available, so you don't know when or where you should deploy this insurance. That is, if I'm a corporation in the status quo, the fact that I very rarely, if ever, insure my investments and I very rarely look for information means that I don't know when insurance is a good option. We solve for this. Third, though, there's just a confirmation bias. You see other investors not taking insurance, so you feel as if it is a good idea to just invest. This proves that insofar as insurance exists, it exists only as an exception and only for projects that investors view as super risky. Why then are we likely to get a market on our side of the house? This is our first argument. First, we just get more competition and more liquidity. I know that OG says the word competition, but the actual mechanism that they're missing is that of a secondary market. The argument goes very simply. The reason why, for example, an investor like JP Morgan is willing to buy a bunch of bonds from an unstable country is that they know that if they look as if they're not going to get any sort of return from the bonds, or if the price is going down, they can sell them on the secondary market to another investor. The issue on their side of the house is when you have this insurance, the fact that it is only being offered in a few instances precludes the possibility of a secondary market, which drives prices up. But in our world, we prevent any sort of monopolization and foster competition because you can just trade the insurance on the secondary market as prices go up and down. Note, this is the actual link into cost because it proves that even if these companies have bad incentives, they have to play nice to attract consumers, whereas the off-world is one with predation. It also flips the ELO claim that you just don't have an incentive to care about the insurance policy you're picking, because obviously you have an incentive to care in a world in which you have multiple options, more so than a world in which you have only more options. Two, I'm going to prove why we get more efficiency and information, which leads to more innovation and more better mechanisms for insurance contracts down the road. And three, I just think we get more research into granular instability. That is, not just whether or not a country is writ large unstable, as to the question that Dennis is asking, but whether or not specific actions of political corruption are likely to affect specific investment. That is, an OO world is the world in which investors are uncertain if the recently elected dictator is going to be good for the future of the country. But an OG world, it is one in which dictator has clear incentives to be very clear up front about which sorts of investments they are likely to target because of the existence of the mandatory market. So they say, hey, I'm not going to touch your oil rig, but I am going to touch these investments. This is unique on our side of the house. Why then are investors fine with stomaching an extra premium? First, it is often small compared to the potential of recouping a large amount of money. That is, these corporations are very rich, and a premium every month is priced by insurance companies in such a way that most are willing to take this rational calculation. Two, they just still have to invest. This mandate affects all corporations equally across the board. They still make money through stuff like FDI, buying bonds, etc., and are still attracted to these investment options. Dennis says the alternative is you just invest in fucking Bitcoin, but obviously not. Like, a fucking sovereign stock portfolios are not going to shift to Bitcoin instead. Bonds represent a particular type of investment, which means if anything, you are still going to invest on our side of the house, and you're just going to stomach the cost of premiums because you know that all of your competitors are also stomaching premiums. Our second extension, I'm going to take OO at our best, which OG never does. Let's say that there's going to be FDI in both worlds. The issue with OP is this type of investment. Ryan tries to get away with saying that JP Morgan is going to invest in a place and then care about that place and help it be less risky. This is not how it works. The type of FDI that OP gets is bad because JP Morgan is generally investing in unstable places on the edges of their portfolio and are fine with taking losses. So they actually quite literally do not give a shit if the country goes down in a political coup because they know that they probably are going to get returns from other areas instead. The crucial piece of framing under this argument is that most FDI comes in what is called syndicated investment. That is, one investor doesn't want to be the only person investing because they feel uncomfortable dealing with the government on their own, and there's a lack of comfort from other large institutional investment involved in the investment sphere. So often they enter with other large Western investors, potentially with stuff like the UN or the IMF. The issue, though, is there's no incentive to cut in domestic investors on their side of the house. But in our world, there's a very large incentive to cut in domestic corporations in investment deals. One, insurers like people who can monitor the political situation, which could be local banks or even local government. This directly answers Dennis's question, because large multinational corporations are not very good at assessing a micro-political state of a particular country, which is why now oftentimes when it is mandatory to accumulate information about that country, insurers are just unwilling to invest in a large syndicated investment unless they know that investment is working with sources on the ground and has their ear to the pulse of the economy. I'll take a POI from from opening.
We already told you that the local corporations, the governments, and the corporations already want to do this research because they don't want their thing to fail, even if they don't want to sing kumbaya and make the country better. What's the meaningful tipping point to adding a fourth person to the party and now insurance companies?
So the issue is that large corporations are often quite happy to diversify their portfolio and just not to do tons of research into certain areas or write off certain areas as risky or speculative investments. And two, oftentimes, even if they have the incentives, these large corporations just lack the capacity. Whereas in our world, there's direct incentive to cut domestic players in on the deal, which produces the capacity problem that OG never actually solves. Cool. Second mechanism is insurers need these people to have a substantial stake in the deal to trust that they will manage the political situation accurately. This is where things get very, very simple. An insurance corporation does not want companies or countries it is insuring to routinely go through coups which cause it then to have to pay out very high levels of investment to the people buying its insurance. This means it wants the people buying its insurance to have a demonstrated stake in the well-being of that country. This flips literally all of the material from LO because it proves that insurance companies will literally force large and predatory multinational corporations to enter into sustainable development agreements with domestic entities so that they are not going to have to be constantly paying out for the sake of dictators. The weighing on this claim is very simple. Yes, investment is good, but only sustainable investment is the path forward. On our side of the house, you actually get the economy to develop as opposed to selling away the future of your country to the market. For these reasons, proud to propose.
Thank you, Speaker, for that fine speech. Let's welcome the member of opposition. Here.
Can you hear me? Hello?
Yep, you're visible and audible.
My desk is a mess. Under the World Trade Organization, India is classified as a developing country. Mexico is, Lebanon is, Botswana is. All of these are fantastic investment opportunities. The people would benefit from investment, and obviously firms would benefit from the profits they would make in those countries. Why would the government force us to pay a premium? I'm not sure. Let's get into an autopsy of the front half clash. OG builds their case about why this is going to be good. They tell us that it decreases the risk of investment, which is going to increase FDI overall. They never prove why mandating is necessary or why existing risk mitigation strategies aren't sufficient. I think OG is largely out of this debate. We'll get into that later. OO responds that the development classification is subjective, that this reduces the incentive of investors to care about the countries that they invest in. I'm not sure about this claim because it's unclear why it would reduce the incentive to a sufficient degree to see any big, large-scale impacts. Surely the investors still care about keeping these countries afloat. Surely they still want their investments to succeed. But they have a stronger claim at the end, which is about why this is going to depress overall FDI and why the counterfactual world is worse and investments go to worse places. We're going to A, prove why this does not need to be mandatory, B, prove why it's principally unjust, and then C, explain how this creates a middleman class of insurance corporations, which is much worse than the status quo, which has worse incentives, which will also prove the extent of how much this actually decreases FDI that Opt tries to prove. So, firstly, why does this not need to be mandated? Why is the status quo sufficient when it comes to, understanding risk measurement, so on and so forth? I think firstly is that insurance is already offered for people who want it. There are many reasons for this. It's profitable to take people's money. You basically make bets on the outcome of certain countries. Sure, I can bite the bullet that these markets are not as advanced, that these markets are not as sophisticated, that maybe the premiums are more expensive. However, it is the gov burden to prove that the benefit that we get from these insurance markets becoming better outweighs what we already have. So what do we already have? The investors doing this sort of FDI are rich because foreign direct investment takes place in the spans of millions and billions of dollars. These firms can afford existing premiums for insurance. They secondly have embedded risk management firms where risk management departments where they can, actually internally predict whether or not an investment might be risky. They can make decisions based on that risk already in the status quo. Thirdly, they're likely hyper rational. They're dealing with, large regulatory agencies that ensure that they're not losing people's money willy-nilly, which means they're very unlikely to be making risky investments in the first place. Fourthly, they're hiring large amounts of experts with, very fancy titles and fancy PhDs from the best universities. This is very profitable. Investing is very profitable. It's very unlikely that they're losing a lot of money. Investors are generally doing well. Lastly, is that these investment firms already diversify their portfolios in bonds and less risky investments, which means that their portfolios as a whole are generally not so risky that you would need a very strong insurance market to prevent them from going down. So for people without all of these risk management resources, they could buy it. But for the firms that don't need it, it's a bad thing to mandate. It's bad, firstly, because you're reducing their incentive to invest in developing countries that need it much more. But then secondly, and this is something that CG needs to contend with, is that they don't prove that the insurance companies are better than what already exists in the status quo. So we can weigh why firms are better at determining risk than an insurance company, even at CG's best case scenario could ever be. 3 reasons on why internal risk measurement is better than an insurance management firm, even if it's a good one. Firstly, is that the firm has the ability to adjust their risk measurement to the context. So they can do it much quicker. They have, all their resources on that behalf. Secondly, is that you actually know as the firm what you are specifically investing in, what industry you're investing in, where that investment is taking place, which is something the insurance company doesn't know as well as you do, which means you have more information about the project, which means you're better able to make those risk measurements. Thirdly, is that you know your own risk tolerance better than an insurance company knows. So maybe you have a high risk tolerance, maybe your investors don't really care that much about risk, and so you're willing to take those risks. That's something an insurance company would not give you the ability or grace to do, which means that you're probably better off on our side of the house letting companies make their own decisions. Why is this unjust? This is just a quick principle on why it can't stand. I think government needs to prove that the mandate is necessary. They have to prove that the investments that are being made in the status quo are unnecessarily risky. Absent of proving that premise, it's very unclear why it's necessary to be mandated. This is there are groups of people who are making well-informed, well-calculated decisions. Gov says, actually, no, you have to pay this extra premium. You have to pay this. We're mandating you pay this. They already make good decisions. Why do we have to mandate it? Very unclear. It undermines their agency. It reduces their ability to allocate capital effectively. I think at the end of the day, this is needlessly paternalistic, and it's unclear why it's very necessary. Before I go on, does OG have anything?
Okay, I'm unclear why you cannot collaborate with an insurance company of your own choice and negotiate a pay rate based on your market research and their
Sure, it's
market
like
research
you
curve.
already have these capacities to calculate risk. You're a large firm dealing with millions and billions of dollars. Why are you increasing transaction costs? Now you have to collaborate with this firm who's doing something that you were already doing. It's just making it much harder to invest. Instead, I'll just invest in a developed country and lose all of that bullshit. Okay. The big thing that we're going to talk about, why this creates a middleman class of insurers who are solely there to measure risk. I think, firstly, note that these are likely to be profit maximizing corporations that are going to profit most from high premiums and low payouts, right? Secondly, is that the government is now ensuring that you have a captive market of everyone who ever wants to invest into these developed countries. This is eerily similar to what the United States did with the Affordable Care Act, mandating that everyone engage in insurance. Now, I want to note, panel, what we all think of insurance and all of our experiences with insurance companies. They suck. They're terrible. They're constantly increasing your wait times. They're constantly increasing bureaucracy. They're making money off of denying you payouts and increasing the premiums. Housing insurance in Canada is worth billions of dollars. Global investment is worth trillions of dollars. So even a 1% premium that is going to these insurance companies means billions of dollars each year that would have gone in the counterfactual to investing in these developing countries. You are now giving the power and incentive to these companies, these insurance companies, to increase the amount of countries that are labeled as developed, to maintain their position by lobbying, to maximize profits. All of those billions would have gone into developing countries. Those billions would have scaled exponentially, increasing GDP over time. That's something that we stand for and that Gov is trying to get rid of. Very proud to oppose.
Thank you, Speaker, for that fine speech. Let's welcome the government whip to conclude the government bench as a whole. Here.
Here, here. I will take a POI. I actually prefer to take them earlier rather than later. So violent gesticulation on video will get me to take you. Yeah, what Dennis is doing is correct. Sorry, just give me one sec. Before I begin, I want to talk about the 3 contributions CO has to the round. The first thing they do is they echo the DLO and say that insurance is already offered for the people who want it. Look, it's true that companies can buy insurance for many things, machining, workman's comp, rent, but not politics. Mostly because, as the OO very thoroughly proves, it's functionally impossible to price political risk, so nobody buys it. The analysis out of Monty's speech was very clear. Where the market is small, where the mandate doesn't exist, there is so much uncertainty and so much risk that insurance premiums are artificially high as a result of a lack of a secondary market. The mandate is what brings people into the market. And look, I can't prove to you that nobody buys political risk insurance today. That's kind of an unprovable fact claim. But all of the warrants from OO about how impossible it is to price political insurance should prove that there isn't a functioning, efficient market for political insurance. Otherwise, we would be able to price it. CO then tries to prove that firms are better at determining risk than insurance companies. Unfortunately for CO, on CG, we don't have insurance companies pricing risk. We have the free market pricing risk, which includes firms as buyers of insurance and insurance companies as sellers of insurance. So they compare models and agree on a price. So a market that scales up by the mandate brings in both parties to price insurance together, which is the most accurate pricing mechanism in the round. The last thing CO says is there's a middleman class of risk managers. And I want to tie this to the DLO claim of whether or not companies will work with dictators because they no longer care if the government takes your oil rig. Dennis's analysis might work for investors who are like, yeah, I don't really care if my oil rig gets seized. I'm going to get paid out. But it doesn't work for this new middleman class of risk managers, the insurance companies, who would lose a ton of money if the oil rig was seized, because then they'd be on the hook to pay the investor for the oil rig. And they have a ton of incentives to counter pressure to stop strongmen from seizing assets. They're also typically way more powerful than individual FDI investors. One, because they come in with syndicates that distribute this cost and this risk across the global financial market, which has the ability to lobby governments across the world. And two, they just have more money than individual investors. I'll take closing.
The United Nations has proven ineffective at preventing the worst harms of, political risk and so on and so forth. And they are a huge multilateral organization with many more resources than even the best case of your insurance market.
No, this isn't true. The United Nations is a functionally toothless organization that is held at gunpoint by the veto of the G7. Private companies hold way more power and the ability to distribute both economic and political capital in this world than the UN does. Moving on to the top half. Oh, actually, Dennis, I'll take you too. I've got plenty of time.
Super quick. If you're right that insurance companies are so big they can shape foreign policy, then aren't they already big and resourced enough to create the kind of markets that you're talking about? Maybe you get a couple more liquidity, but it's not the binary market or no market.
Dennis, this is the issue, right? Because the market doesn't exist, there's no buyer that wants to step forward and be the first market mover, because that buyer would have to pay an exceptionally high premium because the insurance company goes, well, we don't have policies and procedures in place to price this political risk. We don't know how to do it. There's so much uncertainty. I don't want to lose my job. I'm going to make you pay an incredibly high premium. And so nobody on the buy side steps forward and breaks the collective action problem, which is what the mandate solves. Getting into the top half and repeating a lot of that in constructive. OG, I think, does a great job at proving why FDI is good, but they don't explain why we need to mandate political insurance in order to make it better. Good things do tend to naturally self-develop in free markets, but they haven't self-developed in this one, primarily because one, there is a lot of uncertainty, and two, because there is a collective action problem. Nobody wants to take the first step forward because there is no market on the supply side of insurers willing to offer them good deals. There are just a small number of boutique firms that charge incredibly high premiums. That's not a worthwhile effort. CG uniquely explains why the mandate is needed to create liquidity in the market and solve the first mover part of the collective action problem. Notice that the mandate making the market large also solves for O's intuition about monopolization. When the market is small and there are only a few boutiques that offer political insurance, they have pseudo-monopoly power because the buyers of this insurance can't go and get competitive quotes and competitive prices. When the market is big, everyone from JPMC to Deutsche Bank to HSBC have incentives to enter the market. Notably, a lot of them don't enter as the primary brokers of insurance. They enter as secondary market players who securitize and offer lines of finance to the primary insurance issuers. That leads to multi-layered competition in the primary and the secondary market, creating incentives for firms to enter in the primary and secondary market and to enter on the buy side of the market, breaking any monopoly power that might exist within the market. Lastly, I want to deal with OO and take them out of the round. OO had a lot of claims, all of which are beaten by our extensions in one way or the other. Firstly, on making better investment decisions. The problem with the top half is they seem to think that foreign investment firms can just like understand political risk simply by researching things. And I think they really understate the extent to which political risk involves like intangible questions and concerns that just like aren't available on the internet or aren't available to experts. We posit that politics often requires in-country understandings, an inside edge of what is going on. And this is best understood by local banks or local governments who tend to work very closely with the decision makers in the first place. Notice Andrew's extension here is really critical because what he's proved is that insurance companies don't just want experts on the payroll. They want experts who have an active, large percentage stake in the syndicate, because then those experts won't just advise on political risk. They will be actively able to influence and de-risk those countries, ensuring stabilization, which benefits the insurance company because they don't have to pay out, but it also benefits the local economies. One, because political stability is just a generally good thing if you care about economic growth. But two, because now those local banks in the local governments are going to be getting a larger share of the profits, allowing them to turn around and fund their own projects going forward, creating a positive cycle of economic growth. The second OO claim is less investment. I think syndication in the secondary market already flipped this. The third OO claim was that companies will work with dictators. Again, the insurance companies just won't let them do this. Why would you ever work with a company that was working with the dictator to screw you, the insurance company? You would never offer them insurance. But the last thing I want to say on this is the incentive of insurance companies to work to stop predatory investing and ensure that a healthy chunk of the profits of FDI go back to the host country. Insurance companies know that predatory investing is what leads to political instability. If JPMC is running away with all of the profits and pumping it back to the shareholders, that is a recipe for disaster for the insurance company because they know that there's a very high risk of political instability leading to those assets being seized and forcing the insurance company to pay enormous premiums to the original investors. So insurance companies have an incentive through their premium negotiations to compel these syndicates to bring in local partners, not just as experts making a couple $100,000, but as major equity partners within the deal in order to ensure that the local government prospers, the local country prospers, the local politic prospers, and the FDI that we get isn't just greater in scale, it's greater in benefit for the most vulnerable people in the world. We are very proud to propose.
Thank you, Speaker, for that fine speech. Let's welcome the opposition whip to conclude today's debate. Here.
Am I audible?
You're both audible and visible.
Okay, nice. Just 1 second, please. Speech starts in 3, 2, 1. Okay, what does Humam tell you in this debate? One, that it is principally wrong, right? It is principally wrong and undesirable for like government's plan to actually take action. And just generally speaking, he proves to you necessarily that one, like investors are good at risk calculation in the status quo, and that ultimately the biggest negative impact that we do get in government's world is that we bolster a middleman class of insurance agencies, right? And he quantifies and demonstrates how this has huge negative impacts in developing countries. I think if we're able to prove that we get these horrible outcomes for these like developing countries, like we clearly win this debate on that metric alone, but we also I'll tell you how we win on other metrics as well. Okay, just team by team, pretty easy here. Let's just start with opening government. Okay, so the first claim that we get out of opening government is like essentially this: like less risks equals more FDI, and then FDI is good, therefore like we should support the motion. I think just on the less risk equals more FDI, like I just don't think that's true. I think a lot of the refutation on the LO sufficiently takes down this claim, just generally speaking, relative to how like there are very large scale upfront costs that exist. Also just like some countries won't like just simply won't receive the FDI. I think also just generally speaking is very mechanistically feeble. A lot of it is just asserted. Even more importantly, I think the issue structurally with the case is that when they're proving to us FDI is good, Like, sure, okay. Like, I have no idea why this is mutually exclusive to the gov world. I think we all agree. We're just proving that, like, we get better FDI on our side of the house. Like, none of the mechanisms that they provide as to why FDI is good is, like, exclusive or comparative. I think also of note here is just like the DPM's analysis as to like why mandating is necessary. I think like the critical necessary assumption here, which is conceded by the DPM, is that investors will necessarily have bad payoffs operating in high risk areas. I think this is largely asserted, like presumably like they don't, right, due to like the risk of like existing. I think also like assumes that like incentives don't exist in the opposition world. Humam gives you very strong analysis for like why the opposite is significantly more likely. I think also just on their analysis relative to like better research, once again, none of this is mutually exclusive. This is all highly uncomparative. All of the stuff that can be done all of the stuff that they talk about with their mechanisms can be done on upside world, like with the investors as well. I think the issue of the impact also, like the extent of like meaningful impacts that we get from gov is like basically we get more economic stability. This leads to more democratization. That's a good thing. Sure. Once again, like I have no idea why I should care about this in a way which is exclusive to side opening government. They don't like I find analysis as to why structurally mandating this as a way of like leading to this outcome actually leads to any sort of significant margin, any sort of significant tipping point. I think the way that we take this is very, very clear. We take their case at the best. We outweigh them like just on like brute impact. Like when you compare this to like the externalities that Humam talks about, like the creation of these like horrible like middleman agencies, I think we very, very clearly win that. Okay, so now I'm also just going to talk a little bit about just closing government. Okay, so I think like what's very important to note here is that like mandating this, right, creates a large political risk, like insurance agency, right? Humam gives you like a bajillion structural reasons as to why this is true. I think firms are better at determining risk and making decisions than like even like good insurance markets, because investors, one, have a better understanding of what their actual risk tolerance is, and two, they have more understanding of the risks of your specific investment than the actual market. Also note that companies already exist that benefit from free and stable trade. It's highly unclear, it's very amorphous why insurance companies are actually the tipping point. If you're to buy any extent, like the extent to which they try and impact out their case, you have to like prove that this is the tipping point. I don't think that this is actually accomplished on closing half. Okay. Also, just I think something that's largely overlooked, like by just the entirety of government, is just like Humam's very important framing on like what insurance companies actually like end up being like in the comparative. Right? Just notice here that the framing is basically just insurance companies, right, are just absolutely fucking evil. Like any increase in the insurance market, like, is zero sum with the investment into the developing world. This means that like it's important to note that like this money is vital for the growth and development of those countries. That is to say, there exist mutually exclusive incentives, right, between sort of the outpouring of FDI and also the operation of this middleman market, which Humam has proved to you will exist in government's world. Okay, now let's talk a little bit about opening opposition. I think like the fundamental thing here is that like we stand by a lot of like what they talk about relative to just like especially like with the sort of ref towards OG, like we think that's very, very good. But I think like it does fall to a reasonable extent to the extension from the member of government, such that it is proven that like there exists like a situation in which like investment results in unsustainable and catastrophic results for countries and like the invested capital at stake. Okay, I think like ultimately the weighing here then is like very, very simple. Even if you aren't to buy like to any degree any part of our case besides the principle, which like notice here hasn't been engaged with whatsoever, right? I think like we show you why this is like principally unjust, undesirable to actually like implicate all of these investors into like this mandate of like buying into insurance, right? This impact in the way is like not requisite on any of the economic claims, right? So we bypass like 100% of the government bench refutation, generally speaking, because we don't rely on like any sort of economic analysis, economic mechanisms. I'll prove why the principle actually matters quite a bit later on, but also just like on the clash relative to risk assessment, we also weigh over them easily just on the depth of analysis. Huam gives a ton of reasons as to why like this is actually going to be true. I think this is like relative to risk assessment. This is a very necessary premise to prove anything relative to the outcomes of firm investment. So like we also win on just logical priorities. So we give you very unique analysis on just the rise of the middleman class of like insurers as well. So I think that's just another like totally separate sort of demographic on which you can consider us. Okay, so final few seconds about like why the principle actually matters here. I think like just generally speaking, like if you buy any of the intuition pump, right, that Humam gives you, I think like necessarily that's just a very universal intuition that should hold like relative to this as well. I think like the paternalistic sort of policy that is at play here is highly unnecessary. So proud to oppose.
Thank you. Judges, let's hop onto Discord, and debaters, let's just stay here. It'll be the easiest. Thank you all.